Welcome to the Opening Bell Report.
How does a company, one that operates globally, manages massive amounts of credit risk, and has to maintain strict bank-level capital ratios, consistently generate a return on equity hovering between 30 and 34%?
Right, because in the broader financial sector, sustaining those kinds of numbers over a long period is exceptionally rare.
Yeah, unheard of almost.
Exactly. You typically only see that level of capital return in, asset-light software businesses, not in entities carrying billions in consumer credit exposure.
And that is the paradox we're examining today. We have a detailed analysis report sitting on the desk between us, and it is entirely focused on deconstructing the profit machine of American Express, or AXP.
A literal profit machine.
Truly. And our mission for this deep dive is to completely decode how this vertically integrated financial ecosystem operates, why it's so uniquely profitable, and how it fundamentally diverges from the traditional banking and payments models you are probably familiar with.
Yeah, it's a completely different beast.
Okay, let's unpack this. Let's start right at the foundation.
Yeah.
What is the core structural advantage that separates them from the rest of the industry?
Well, to really understand the profitability of American Express, you first have to look at the architectural divide in the payments industry. It all comes down to network topology.
Right.
If you look at Visa and MasterCard, which are AXP's primary competitors in the transaction space, they operate as open-loop networks.
Open loop.
Yeah. For anyone tracking payment rails, the best way to visualize an open-loop system is to think of a highly efficient toll booth on a multi-lane highway. Visa and MasterCard take virtually zero credit risk.
Because they don't lend the consumer money?
Exactly. They do not lend the consumer money, and they do not hold the merchant's capital.
They're strictly the communication infrastructure.
Yeah, precisely.
They provide those highly secure rails connecting the issuing bank, say a Chase or a Citi, that actually provides the credit line
Right.
to the acquiring bank that processes the payment for the merchant. And for facilitating that authorization and clearing process, the open loop network collects a fraction of a cent, or just a very tiny percentage, on the volume.
And, that asset-light model is brilliant in its own right. It yields incredible operating margins. But American Express chose a much more capital-intensive, but ultimately more controlling path.
The closed loop.
Yeah, they operate a closed-loop network. They act simultaneously as the card issuer, the payment network, and the merchant acquirer, all rolled into one single corporate entity.
I love how the analysis report refers to this structure. It calls it a three-headed monster.
That captures the dynamic perfectly.
It really does. Instead of relying on a partner bank to acquire the customer and then another partner bank to sign up the merchant, Amex just builds and maintains relationships with both ends of the transaction directly.
And the strategic value of that three-headed monster setup becomes super obvious when you map out the unit economics of a single swipe.
Okay, walk us through that.
So in an open-loop system, the merchant discount rate, the fee the store pays to accept the card, it gets fractured.
Right. Everyone takes a slice.
Exactly. The issuing bank takes the lion's share to cover credit risk and rewards. The network takes a processing fee, and the acquiring bank takes a margin for settlement.
With Amex.
With Amex, because they control the entire transaction lifecycle from authorization to settlement, they do not fracture those economics. They capture the entire merchant discount fee.
Which gives them immense pricing power.
Huge.
This integrated model is the direct reason why Amex can historically charge merchants slightly higher swipe fees, often hovering in that 2 to 3% range depending on the merchant category.
And that premium pricing has always been the main point of friction.
Oh, for sure.
You see it play out in the real world when a smaller retailer or, an independent restaurant pushes back and refuses to accept Amex due to those higher interchange costs.
We've all seen the signs at the register.
Right. But the reason the network sustains that pricing power globally is because of the specific demographic they deliver to the point of sale.
Because the merchant is essentially making a calculated customer acquisition trade-off.
Yes.
They're willing to swallow a 2.5% swipe fee instead of a 1.5% fee because the data consistently shows that an American Express cardholder has a significantly higher average ticket size.
They spend more.
Exactly.
Yeah.
The network is delivering a highly coveted, affluent consumer base right to the cash register. The merchant isn't just paying for payment processing, they're paying for access to that specific wallet.
And securing that specific wallet requires a completely different psychological approach to the consumer. American Express doesn't position itself as a traditional credit facility.
No, not at all.
They position themselves as a membership club. They sell access to a premium lifestyle, and that membership model serves as the high-octane fuel for their capital structure.
The financial mechanics of that membership model are just staggering, honestly, particularly when we look at the concept of massive unearned revenue.
Oh, the unearned revenue is incredible.
Just take the flagship Platinum card, which currently carries a $695 annual fee. Amex collects that cash up front.
Day one.
Before the consumer has stepped into a single airport lounge, before they've utilized a single dining credit, the company has collected billions of dollars in aggregate across its global user base.
And if we look at their balance sheet, that upfront cash represents a monumental structural advantage.
Zero cost capital.
Precisely. By collecting those billions in annual fees on day one of the billing cycle, American Express is essentially generating massive zero-cost capital. They don't have to tap the debt markets or pay federal funds rates to secure that operating capital.
That is wild.
It's an incredible float. It's actually somewhat similar to the float an insurance company generates from premiums, but applied to consumer finance.
And it also smooths out their earnings volatility, right? Traditional retail bank revenue is highly cyclical, fluctuating wildly based on the yield curve, interest rate spreads, and consumer appetite for taking on debt.
Yeah, it's very reactive to the macro environment.
But subscription revenue from premium cards is incredibly sticky. It provides a highly predictable baseline of cash flow, regardless of whether the broader economy is in an expansion or a slight contraction.
And that predictability ties into a fundamental distinction in their business model. Unlike a traditional retail bank that is lend-centric, American Express is overwhelmingly spend-centric.
Because a traditional credit card issuer relies heavily on net interest margin.
Exactly. They actively want the consumer to revolve a balance and pay an 18 or 20% annual percentage rate, because that interest is their primary profit engine.
Whereas Amex operates almost entirely upside down compared to that standard banking model.
Completely upside down.
The vast majority of the revenue is derived from transaction volume and those upfront membership fees. In fact, their structurally ideal customer is actually someone who pays off their entire balance in full every single month.
Right, but who runs hundreds of thousands of dollars of travel, dining, and business procurement through the network.
Exactly.
And what's fascinating here is the secondary cascading benefit of targeting that specific type of transactor.
The credit risk insulation.
Yes. By optimizing for high FICO, affluent consumers who use the card as a payment utility rather than a borrowing facility, American Express structurally insulates itself from the massive credit risk that usually weighs down the balance sheets of standard lenders.
So in a macroeconomic downturn, when default rates spike, traditional banks have to dramatically increase their loan loss reserves.
Which immediately eats into their return on equity.
Right. But AXP's exposure to those catastrophic default spikes is significantly lower because of the underlying solvency of their transactor base.
Okay, here's where it gets really interesting. The closed-loop system, the premium swipe fees, the zero-cost float from annual fees, and the insulated credit risk. These are all formidable structural advantages.
They absolutely are.
But they all serve as the foundation for the true catalyst of this profit machine: deterministic data at scale.
This is the intersection where their structural network topology translates directly into an informational monopoly.
Because American Express is both the entity issuing the card and the network processing the data packets of the transaction.
Exactly. They possess a level of granular consumer visibility that open-loop networks physically cannot capture.
And the analysis report uses this great hotel receipt analogy that illustrates this perfectly.
It's the best way to understand it.
Right. So if you're tracking consumer behavior, understanding the nuance of a transaction is everything. Let's say a consumer spends $500 at a luxury resort.
If that transaction is routed through a traditional open-loop network, the data packet that reaches their network operator is essentially just a top-line figure.
Right.
They see a $500 authorization request from that specific hotel merchant. It's essentially a blank receipt with a total at the bottom.
They know the where and the how much, but the what remains a total black box. The open-loop network has no visibility into the individual line items that make up that $500 total.
But when that same $500 transaction flows through American Express's closed-loop rails, the informational yield is entirely different.
Because they're the acquiring bank integrated with the merchant's point-of-sale system.
Exactly. So they ingest the exact granular breakdown of that receipt. They see that the consumer spent $200 on the room rate, $200 at the hotel's Michelin star restaurant, and $100 on a deep tissue massage at the spa.
And the distinction between probabilistic data and deterministic data really cannot be overstated here.
Tech platforms often have to guess consumer preferences based on probabilistic browsing history or search queries, right?
Exactly. But American Express doesn't have to guess.
Yeah.
They have a deterministic ledger of exactly what their highly affluent user base values and purchases in real time.
And the monetization of that deterministic data is where the margins really expand. Because data at rest is merely overhead, But data in motion is an asset.
A massive asset.
American Express operationalizes this line item visibility through platforms like Amex offers, which sits right inside their mobile app and online portals.
They have effectively built a hyper-targeted performance marketing channel hidden inside a financial services application.
Yeah.
Because they have a precise map of consumer spending habits, they allow luxury retail brands, airlines, and hospitality groups to run incredibly specific advertising campaigns directly to the cardholder.
So if a brand wants to target consumers who specifically over-index on fine dining, but haven't visited their specific restaurant group in the last 6 months, Amex can execute that targeting with absolute precision.
Down to the dollar.
The brand funds the statement credit or the points multiplier, and Amex takes a margin for facilitating the conversion.
It creates an entirely separate, high-margin revenue stream that operates distinctly from their core payments business.
Which competitors just can't do.
Right, because competitors operating on open-loop rails simply lack the infrastructure to ingest line-item receipt data at scale. This advertising platform acts as a formidable competitive moat. You cannot easily replicate a performance marketing network if you don't own the underlying closed-loop rails.
So we have mapped out a series of compounding advantages here. The closed-loop architecture capturing unfractured economics, the upfront, zero-cost working capital generated by membership fees, the structural insulation against consumer credit defaults, and the high-margin monetization of deterministic data.
It's a powerful combination.
It is. And I want to synthesize all of this into the actual financial output. How do all these architectural choices mathematically yield that sustained 33% return on equity?
Well, the math rests on 3 primary pillars, beginning with the inherent operating leverage of a proprietary payment network.
Because at its core, running a transaction network is a fixed cost endeavor.
Exactly. It requires immense upfront capital expenditure. You are essentially laying down global digital railroad tracks. You have to build the data centers, engineer the cryptography and security protocols, and establish the physical merchant acquiring relationships in hundreds of countries.
And that initial build-out takes decades and billions of dollars.
Oh, yeah. But once that global infrastructure is mature, the marginal cost of processing one additional transaction is virtually zero.
Right.
Whether the network handles 10 million transactions a day or 50 mutual transactions a day, the underlying cost of the data centers and security protocols remains relatively flat.
So as global payment volumes scale up, the incremental revenue flows almost entirely to the bottom line.
Yes. This fixed cost leverage creates exponential margin expansion as the network effect grows.
And that dynamic generates a staggering amount of liquidity. Looking at the financials in the analysis report, American Express consistently produces roughly $16 billion in free cash flow annually.
$16 billion. It's a massive number.
The sheer velocity of that cash generation forces a critical corporate finance decision, which is capital allocation.
Which brings us to the second pillar, strategic capital return.
Right.
Because generating $16 billion in free cash flow is impressive, but how management deploys that cash dictates the return on equity. American Express has a long-standing strategy of using a massive portion of that cash flow to aggressively repurchase its own shares on the open market.
And the compounding math of those continuous buybacks is what supercharges the ROE. Because they are systematically retiring shares year after year, they are constantly shrinking their equity base.
The denominator.
Exactly. So you have a scenario where net income is steadily rising due to the fixed cost leverage of the network, and simultaneously, the denominator, the total shareholders' equity, is being actively reduced by billions of dollars a year.
It's pure financial physics.
Right. That constant denominator reduction is what, artificially but sustainably, pumps that return on equity metric up into the mid-30s.
They are essentially baking a larger and larger profit pie while continuously reducing the number of slices it gets cut into.
That's a perfect way to put it.
But to fully understand the ecosystem, we have to look at the third pillar, which acts as a counterweight to that profitability.
Controlled margin compression.
Exactly. The analysis of their income statement reveals this dynamic really clearly. They generate immense cash, but they also deploy capital aggressively back into the product.
To maintain that premium lifestyle positioning.
Yes, and specifically to acquire the next generation of affluent spenders, the Millennials and Gen Z. American Express incurs massive customer acquisition and retention costs.
Because the premium credit card market has become an absolute arms race. Competitors like Chase and Capital One have realized the value of this transactor demographic and have launched their own premium offerings.
So to defend their moat, Amex has to invest heavily in tangible ecosystem perks. We're talking about the capital expenditure required to build, staff, and operate the Centurion lounges globally.
And the hundreds of millions of dollars subsidized for Uber credits, airline fee incidentals, premium hotel upgrades.
Right. That level of premium subsidization costs an absolute fortune, which naturally drags down short-term operating margins.
So they are deliberately choosing to compress their margins today to acquire a user.
Exactly. The financial justification for that heavy upfront spend lies entirely in the lifetime value, or LTV, of the customer.
Because the upfront cost to acquire a younger demographic cardholder with those flashy, high-cost perks is substantial.
Substantial, yes. But because of the recurring, sticky nature of the annual subscription fees, combined with the exponential growth in that cardholder's transaction volume as they advance in their career, the return on that initial acquisition cost is immense over a 10 or 20-year horizon.
They've calculated the exact terminal value of these cohorts. They know they can absorb the short-term margin hit of an expensive lounge network because the long-tail economics are so favorable.
It's a very calculated bet.
And even with those massive ongoing investments in customer perks, their financials show they maintain a highly sustainable, steady net profit margin that consistently hovers right around 15 to 16%.
It is a finely tuned engine. They use the fixed cost leverage of the network to generate the cash required to fund the premium arms race, all while shrinking the equity base to deliver outsized returns to shareholders.
It really fundamentally alters how you look at the mechanics of consumer finance. Let's synthesize the core architecture we have explored today.
Sounds good.
We started by dissecting the closed-loop system, the three-headed monster that refuses to fracture the merchant discount fee, allowing them to capture the full unit economics of every swipe.
Right.
We examined the capital efficiency of generating billions in zero-cost working capital through upfront membership subscriptions, which simultaneously insulates them from traditional banking credit risks.
The spend-centric model.
Exactly. We broke down the hotel receipt analogy to highlight the immense value of deterministic line-item data and how they operate a high-margin performance marketing network right inside their banking portals.
EMX offers.
Yep. And finally, we analyzed the aggressive capital allocation strategy, leveraging a fixed-cost network to produce $16 billion in free cash flow and relentlessly shrinking the equity base through buybacks to sustain a 33% return on equity, all while defending their premium moat through calculated margin compression.
The architectural cohesion of the model is what makes it so resilient. It forces a broader perspective on the infrastructure we interact with daily.
It really does.
What stands out to you, Hugh, listening right now, when you audit your own digital wallets or look at your transaction histories, how does understanding the mechanics of deterministic data and closed-loop rails change your perception of who is actually capturing the value of your spending behavior?
It certainly clarifies the hidden economics behind those premium rewards and annual fees. And as we conclude, we want to leave you with one final structural question to consider, building on the vulnerabilities and strengths we've discussed today.
A look to the future.
Exactly. We have established that American Express's ultimate competitive advantage is their control over a closed-loop ecosystem, allowing them to act as both a dominant data broker and a highly targeted ad network for the affluent.
Why?
So, looking ahead at the next evolution of payments, what happens if the massive technology conglomerates, the entities that already design our smartphone operating systems and control our digital hardware wallets, decide to bypass the traditional open-loop banking rails entirely?
Oh, wow.
If a hardware giant decides to build its own fully integrated closed-loop financial ecosystem from the ground up, who will ultimately monopolize the future of our deterministic spending data?
That is the structural battleground that will define the next decade of the global payments industry.
It's a massive shift to watch out for. Thank you for joining us on this deep dive into the underlying mechanics and capital efficiency of the American Express ecosystem. We always appreciate the opportunity to deconstruct these complex financial architectures with you. Keep analyzing the models behind the products, keep questioning the consensus, and keep learning. We will catch you on the next Deep.
Don't forget to like, share, and subscribe for more.